Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Yes, we are a SEC-registered fiduciary headquartered in Oak Brook. If you know where the Fidelity office is in Oak Brook, we are on the 5th floor, so we're right across from the mall. If you are listening to this show outside of the Chicago market, know that we can work with you. We are trying to expand and look forward to expanding the radio show in many, many markets in 2026 and beyond. Our job, I think the job of any financial advisor is education on how to craft portfolios that can deliver positive returns even in negative markets. That is our job. That is our goal. That is what I think that we have to make sure that individual investors are incorporating inside of their portfolios. And that is why education is everything that we do. So 630-492-1912, 630-492-1912. If you'd like to have a conversation, if you'd like to talk about tax reduction, if you'd like to talk about strategies, again, like the bank notes, we're still pricing very, very strong on the bank notes. And anytime we talk about any kind of investment related product, anytime we talk about any tax reduction strategy, anytime we talk about performance, obviously that is for educational purposes. You have to make sure that you fully understand an investment. You don't make investment decisions simply based upon performance. Any performance data quoted is always backward looking. You can't predict future returns. And so that's why we have to make sure that, we are always being just very transparent that what we talk about on the radio may or may not apply to you. And that's where the financial plan comes in. And that is what I think is the heart of everything that we do. And our financial planning, it is different. Our financial planning and the level of tax reduction that we look at and the strategies to reduce taxable income for higher net worth individuals is so significant. It is different. We'll run out your tax strategy to age 95. We'll look at the RMDs. We'll look at ways to convert to a Roth by pairing that with the energy strategy that has tax reduction built into it in the investment. So if you have any interest in anything that we talk about, the easiest way to get on our calendar is to reach out 630-492-1912, 630-492-1912. A lot to get you this week. The markets are what the markets are. We're starting to see a lot of individuals who have been, bullish forever start to come out with some pretty interesting, anticipation as far as what could happen in 2026. Tom Lee is one that I like to follow. Anytime I'm feeling down in the market, I just try to go find him. He's very, very bullish all the time. And I like that. And I also like individuals who share, differences of opinions. And that's where we can kind of, unlike politics, all we care about is making money. And so we want to hear conflicting opinions from credentialed people to really try to identify what we think is going to be the best strategy for our clients. But Tom Lee came on CNBC last week and said, watch out for a potential 10 to 15% drop in the S&P 500 in the first half of 2026. That certainly is a possibility. There's absolutely no doubt about that. And we have to be prepared. You have to be prepared before something like that happens. So again, if you're looking to make changes, if you're looking for ways to reduce your taxable income, if you're looking for strategies like the banknote strategy, again, that strategy, I can't believe how many individuals reach out. I absolutely, positively love it. I'm shocked that advisors are still not adopting a strategy that's been around for decades and decades because they don't want to work hard. They don't want to have the administrative headache. They don't want to really just do what I think their job is, which is to educate investors on strategies that have built-in downside protection. And as you know, the banknotes, every bank has a different name for them, but it's the JP Morgan, Citibank, Bank of America's, Morgan Stanley, UBS's of the world. The strategy that we use, again, 100% customizable, but the strategies that we use are tied to three indexes. And as long as those indexes don't go down 30%, then you're paid your monthly coupon. And they're still pricing. Actually, it's a relatively weak pricing environment, and we're still getting over 11%. So we're somewhere in that 11 to 12% range. And as volatility picks up, that range will obviously increase. But when you can look across the table from a client, and what most individual investors have been told is that you have to use annuities, you have to use these lifetime income annuities to protect. And we're guaranteeing this, and we're guaranteeing 30%. We're guaranteeing, a 30% bonus rather, a 7% growth rate a year. If you're being pitched that, I know who's doing it on the radio. You guys, if you listen to the show, you probably listen to other shows. So you know who is, holding themselves out as a financial planner, as a fiduciary, as an asset manager, as a, somebody that wants to get individuals from point A to point B with the least amount of risk. That's how they're holding themselves out. But yet all they do is sell these lifetime income annuities. And when you look at the lifetime income annuities, you have to understand what inflation is going to do to those fixed payments. You have to look at that. And when you compare a banknote strategy at 11 to 12 to 13% with 30% downside that you can own for as little as 6 months, or I've never seen it. I guess it could go out 60 months. But again, that is an extreme Armageddon situation. And you're making double-digit returns on that cash flow. Man, if you're being pitched an annuity, if you own one, let's compare that to the banknote. So 630-492-1912. 630-492-1912. Next year is going to be interesting. We think inflation is going to rip. We think inflation, the Fed is going to, it's just print. I think that's why you're starting to see a lot of individuals really look at commodities. Obviously, commodities and many of the commodities have done very, very well. As many of you know, we also are the general partners of a oil and gas fund that invests alongside of the majors, the Exxons, Conocos, Chevrons of the world in tier 1 acreage in the Permian Basin. Just Google Permian Basin. Many individuals here in the Midwest don't have that kind of working knowledge, but the Permian is arguably the best oil and gas field in the world. Certainly here in the United States, 40%, 45% of domestic production comes from the Permian. But we spent a lot of time here in the fourth quarter talking about that strategy for two reasons. One, tax reduction. You have until 12/31 to affect your taxable income for 2025. And oil and gas, energy investing has phenomenal tax benefits. Again, I can't provide tax advice. So this is for educational purposes only. Best practice is to always reach out to your tax professional. The oil and gas tax benefits are very, very black and white. But the tax benefits are significant. Our target is to reduce your taxable income by $80,000 for every $100,000 that you invest. And that is against active income or passive income. So the use case for that strategy is not only diversification, which is what we're really going to talk a lot about in 2026, is I see so many of these advisors simply have their investors' portfolios in closet index funds, meaning they're in equities and they're fixed income. That's it. And that is shocking to me because, yes, equities have done well. Fixed income, traditional bonds, obviously, have been in one of the worst drawdowns in history over the last 5 years. But advisors are still doing what's easy. Advisors are still doing what's easier for them, and that's a problem. And it's a real problem. And when you compare any traditional fixed income strategy on the bond side to the banknote strategy, we'll let you decide. I mean, here's a way to get double digits with 30% downside, or do you want to be tied to interest rates and look at the total return of bond funds? Just pick your favorite bond fund. Pick the AGG, which is the aggregate index on the bond strategy and look at the performance over the last 10 years. I mean, it's terrible, but yet so many advisors are using it still because it's easy for them. So 630-492-1912, 630-492-1912 if you'd like to have a conversation with us. But on the energy strategy, yes, taxable income, money needs to be invested by 12/31. You've got a couple of weeks left. If you have any interest to affect your taxable income for 2026, now is the time. Give us a call, and we'll certainly, we have videos, we have educational videos. And if you don't know already, and most of you do that listen to the radio show, we pride ourselves on education. We pride ourselves on, I don't have a co-host. I will never, can't say I'll never, but I can never envision having a co-host on the radio that is reading a written script with planted questions. It's shocking to me. I think what resonates to investors who listen to this radio show and the podcast of the radio show is simply the fact that I don't have a script. My script is to educate you so you can make less money when you need it, which means when the markets are down. Because it's not me that's calling for market corrections. It's not me that thinks that the market ultimately is going to go down. They're going to print money. That, I think, is the consensus. They're going to print next year. And what is that going to do to the high-flying names? I don't know. Warren Buffett, 30% cash. Druckenmiller, which is, these are phenomenal hedge fund managers, is hiding out in healthcare. Paul Tudor Jones, it seems like he has, puts and bets against everything. Tepper is hiding out in China. Dalio is hiding out in gold. What are they telling you? What are they telling us? Are they telling us that everything is all right? Or are they telling us that, there could be some issues? And I'm so tired of individual investors, the $500,000 to, $20 million investor that just simply has an advisor that crafts portfolios that they simply ride the market up and they ride the market down. And that is my concern, because it's simple math. Markets are down 30%. You have to make 43% the following year just to get back to even. Think about that. 20%, it's 25%. 30%, it's 43%. Just to get back to even. And so when you meet with us, we spend our time on making sure that if and when the markets go down again, how are we going to make sure that our clients are protected? 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're an independent SEC-registered investment advisor. We are a fiduciary. Everything that we do is to make sure that we are crafting portfolios that if and when the markets do go down again, maybe they won't. Maybe the markets will never go down again. And you know what the beauty is? I think in our portfolio, we win in that market as well. I think when you want to craft a portfolio, you need to look at 4 buckets. And we're going to talk about those 4 buckets this week, or this segment rather, because again, it's really simple. Charlie Munger said, I don't ever want you to forget this. Investing is simple. Do not interrupt compounding unnecessarily. Do not interrupt compounding unnecessarily. And my fear is that if and when the markets do go down 15, 20, 25%, that your advisor, or if you're managing the money on your own, that you don't have strategies inside of that portfolio that can at least protect principal or even make money, like the banknote strategies. Again, the banknotes, we're still pricing north of 11%. These strategies are offered by JP Morgan, Citigroups, BNPs, Bank Americas, BMO, UBS, Morgan Stanley, etc., the largest financial institutions in the world. And they are still pricing. I say pricing, that means what they're paying. But we did a banknote last week and it was slightly over 11%. The week before, I believe we did one that was over 12%. and you will get that monthly coupon as long as the indexes that note tracks are not down. It is not down 30%. So you basically have 30% protection before you don't get the monthly coupon. So if you have any interest in that, let's talk. 630-492-1912. 630-492-1912. You look at the markets and, you look at what a lot of individuals are, coming out with and they're saying, and then I listen to, the buy and hold crowd, and again, we're not against buy and hold. I mean, we think you need to buy and hold for a period of time. We think you need to have active management for a period of time. And the problem with this financial advice business is most individuals, most advisors, they either believe in active management or they believe in buy and hold. Well, here's the reality. They both work. They just work at different times. So they both work and they both don't work. Rather than incorporating, here's how we look at it rather. So when you look at kind of, managing money and you look at how we look at managing money, obviously financial plan, you're the CEO of your company. We're just the advisors that are helping you with 28, 29, however many years of experience that I have. And we're able to cut through things. We're able to really identify, the pitfalls, the benefits in a way, we believe that's going to be much, much faster than you. Not because we're smarter, not because, we think we're better than you. It's just we have, a ton of trial and error over the last, 26, 7, 8 years, whatever it is, that we have already made mistakes in the past. We know what to look at. We know things that you probably just simply don't know. And advisors' jobs in many instances, when they have these closet index funds, what do I mean by closet index funds? It's just a strategy that tracks market up and down. I'm so happy that people who listen, at least to my radio show, are wising up to those types of advisors. And that is why I think we're experiencing the growth that we are. And it is significant. Our growth is very, very significant. And, from the radio show, we'll probably have 2 to 5 people reach out a week. And so we are always in front of new investors. And what that means to me is that we can help more people. That means that people that listen to the radio show, I hear it over and over again. I've listened to you for a year, 3 years, 5, whatever that number is. And now I finally have to reach out. And that's okay. My goal now, again, it's not self-serving, but my goal is to try to get you to reach out sooner. And that is simply to potentially protect your portfolio from a market downturn. And again, the markets, have they just haven't gone down really for any real length of time. And, the big question is, are we just in one of these debt fueled, cycles of the market, going up over, since 2008, but certainly since COVID. And so how sustainable is the trajectory of the up market? And so, buy and hold, when we look at, managing money, we don't want to, say one's bad or one's worse. When we look at managing money, it's a really kind of a 4-pronged, 4-pillar approach. You want protected growth, you want opportunistic growth, and you want, private equity, alternative, tax reduction, call it what you want. And the beauty of our strategy is that we have some active management, significant active management in our portfolio, and we have buy and hold as well. And so we don't have to look at a client and try to justify why we were right or why we were wrong, because we know that buy and hold and active management works. We also know it doesn't work. And so rather than trying to show you 100-year chart of, don't worry about it, just, buy and close your eyes and you're going to be fine. That to me, that kind of a philosophy from an advisor, the very first thing I would say is, why am I working with you? Why am I paying your fee if you're not going to incorporate, ways that can reduce my taxable income, that can, put in strategies that are not correlated to the market, like the energy strategy and the cash flow that is going to come from the energy strategy, or that is coming from The energy strategy. Now, I'm not saying that there's not things that can affect it. Of course there are with, certainly the price of oil. But it's not going to be affected by, directly affected by the S&P 500 dropping 20 to 30%. I think everything is affected in a down market, but hopefully you get my point that we want to own the zigs and the zags. We don't want to have to make sure that, we are trying to time the market. Now, there's a lot of people that can do that. They don't need your money. And if they do need your money, then they probably can't do it with any regular success. So any interest you have in anything investment related, we love to vet products. We love to vet strategies. So just give us a call, 630-492-1912, 630-492-1912, because before I got off on this rant, buy and hold works until it doesn't. Look at Citigroup, right? I love Citigroup. Citigroup is a bank. Citigroup is an investment. We're not saying to buy Citigroup. We're not saying, to not buy Citigroup. But if you look at that stock and if you look at what that stock did pre-08, the stock was a high flyer. And then look at what it's done since 08. Just Google it. You guys can find this out. The symbol C. And go, just do go to, just go back to 2000 and look at the performance and look at what it did. And my biggest fear is, and we're starting to hear this over and over and over again, and I want you to please, if you hear nothing today on the radio show, you need to, you need to listen to kind of what I am going to say now. We have big banks, big investment firms, big hedge funds that are coming out and saying, based upon the current valuation, what does that mean? It means the current price of the stock market, the valuation of the stock market. Historically speaking, the 10-year annualized returns going forward are flat. So when you think about that, you have to question, can my portfolio at my time, where I'm at in my life cycle, can my portfolio withstand no growth over a 10-year period? I'm not calling for that. I'm not saying that is going to happen, but minds and computers in history has told you at current valuations, the next 10 years worth of returns are flat. Now, maybe this time it's different. I think those are the four most expensive words of investing. Maybe it's whatever. This time it's different. But that's what we're facing today. And when you have, the markets do what they do, and so many advisors, their answer to a down market is to sit and wait. Well, that's because they didn't prepare. That's because they didn't have those conversations with clients on strategies that can still deliver positive returns in negative markets. Strategies like the bank notes. We're still pricing 11, 12% by the biggest banks with 30% downside protection of the indexes that are tied to that note. And it's such a simplistic strategy. It's a prospectus item. A prospectus item. You have the prospectus, so you can read it and you can decide if it makes sense for you. But I find over and over again that people call in from the radio show simply because of that. And this strategy is not cutting edge. This strategy is, I thought it was cutting edge in the early 2000s, mid 2000, 3, 4, 5, 6. Today, it's certainly not. So 630-492-1912, 630-492-1912 if you'd like to have a conversation. Because my fear is, that clients, they are not, set up. And when you have, just Google Apollo. Again, this is just one opinion. It doesn't mean that they're right. But we're starting to see this opinion over and over again. Apollo's chief economist came out, and I don't know if he predicted it or if he said that, historically, excuse me, getting over this cold, historically, I don't know what, he was trying to convey or what message he was trying to convey, but excessively high PEs, like we have right now, price to earnings ratios typically are followed by low returns. And historically, we're looking at very, very low returns for the next 10 years at current valuations. And here's our job. Our job is, okay, if that happens, how are we still going to make money? How are we still going to beat inflation? If we're running inflation at 3 to 4%, what is that going to do to your purchasing power if you just have a buy and hold strategy that tracks market up and down? 630-492-1912. 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC registered investment advisory firm. Yes, we are a fiduciary. Thank you for listening to the show. We love it. We podcast every episode that we do. Hope everybody's enjoying December. December for most people is calm. December for most people is slower. Not for us. We also are the general partners of a oil and gas non-operated oil and gas fund that invests alongside of in the deals of the majors. So the Exxon, Chevrons, Conocos, Matadors, Mewborns, Occidentals of the world in the Permian Basin, tier 1 acreage of the Permian Basin. That is a strategy that provides fantastic tax benefits alongside returns that are not correlated to the S&P 500. So we really push and have a strong bias towards cash flow in that strategy. And as I was mentioning towards the end of last segment, that based upon, and again, you can argue with me, and I'm not calling for no growth over the next 10 years at all, but the numbers historically states that the markets at as expensive as they are today, the next 10-year returns are very, very low. And we're starting to see a lot of people, say that and show that. So our job is to make sure that if that happens, that our portfolios, that our clients still have strategies that, can deliver those positive returns. So 630-492-1912, 630-492-1912 if you'd like to get onto our calendar or have a conversation. And I love it. We're headquartered in Oak Brook, so we're headquartered right across from the mall. If you know where the Fidelity office is in Oak Brook, they're on the first floor. We're on the 5th floor, suite 530. So as you get off the elevator, you turn left. Stop in. I love it. We have people actually stop in. You don't need an appointment. Stop in and come and check out all of our signed football jerseys that are going to take you down the 80s kind of memory lane of the Chicago sports teams. And just stop in. The only, the downside is that we're in a meeting, which, we probably will be. But, wait 15, 20, 30 minutes, have some coffee, and we'd love to chat with you. So I love that people are actually taking me up on that. So please do that. 630-492-1912. 630-492-1912. So back to the if we have a period of lower growth over the next 10 years, my fear is that most advisors, simply their portfolios that they're crafting for individuals are not going to be able to handle that. Most individuals, advisors, it's been my experience that they basically craft a closet index fund, which is just basically strategies that track the market up, track the market down, and that's good until it's not. And I would never pay for that type of strategy. Go to Fidelity, go to Schwab, go to and our custodian is Charles Schwab. But Schwab has a side of their business, a very large side of their business that you can do it yourself. Meet with an advisor, go to Vanguard. I mean, if you believe that the markets and you believe the best way to manage risk is to simply buy something and forget about it and never touch it again, you don't need to work with an advisor right now. I mean, how did that strategy work in the early 2000s? How did it work in 08? How did it work in 18? How did it work in 22? How is it going to work, forward looking in 2025 or not 2025? My goodness, this year's over, but 26 to 2036. And, there are other strategies. And if you listen to my show, you probably listen to other radio shows, and the bulk of radio is, in my opinion and my belief, not just here in Chicago, but throughout, the United States, they're financial management shows, but they are really just closet index fund or closet strategies for annuities. And we, often get tagged as, we don't like annuities. No, we don't like the wrong annuity, right? We don't like the wrong annuity. I see so much of this money going into these lifetime income annuities because, you get a 30% bonus. Who's going to give you 30% bonus? Come on. I mean, what is that tied to? It's tied to income bonus for your income base rather than your actual money base in most situations. And if you are getting a big bonus, then they're going to put really just lower the growth. They're going to meter the growth on what you can, on how much that can grow. And then you have these fixed income payments at some point in life, 5%, 6%, whatever it is tied to, this number. The 7% guaranteed growth. I can't tell you how many people on this radio. I'm telling you, there's other radio shows on this station that, they meet with individuals, have met with them, have worked with them, and then they come to us and they say, well, we were told it's going to grow at 7% a year. Well, what's growing at 7%? Your real money? I mean, if something is guaranteed to grow at 7%, we're going to allocate to it. If there's no risk, we're going to allocate something that's guaranteed to grow at 7% a year. Everybody should do that. But your income number is what they're talking about. And so the way that these insurance companies work, again, doesn't mean it's a bad thing. You just need to know it, is that you're then going to take a certain income payment based upon your age, and you're going to get that for life. Sounds phenomenal, doesn't it? Absolutely phenomenal. Well, here's the strategy. You're only taking your own money out until the account goes to zero. When the account goes to zero, then you're in the insurance company's pockets. I think actuarially, the insurance companies know how many accounts are going to go to zero or not. And my concern is if we're in a high inflationary period, what is that going to do to your purchasing power? And if you haven't looked at it, you need to have that conversation. If you bought one, we need to have a conversation about that. 630-492-1912. 630-492-1912. On the annuity space, we have a 5-year annuity that we use that we absolutely positively love. Again, our strategies: protected growth, opportunistic growth, private equity, alternative, tax reduction. That's it. 4 buckets, 4 pillars, 4 sleeves. Call them what you want. And our annuity strategy, and I don't even care that's an annuity strategy. I mean, it's just, it is. It's only 5 years. But here's what's different. It's a pure growth strategy. Your worst year is zero. Worst year is zero. It's tied to the S&P. You don't get dividends, unfortunately, so it's tied to the price movement of the S&P. And currently, it's capped at 10.75 a year. So if you're happy with 0 to 10.75% of the year of the S&P, excluding dividends, and if you get that gain is locked in, never to go back down, and it's a very short-term strategy of 5 years, that could be the best investment for you. That could be the best investment for you. That's the place that I find the annuity space to really, really do well. I don't find it to do well for cash flow. I think there are better strategies for cash flow. Now, if you have a couple $100,000, $500,000 to your name, maybe it's the best strategy there is, okay? Because it gives you that level of certainty. But once you get up to 7 figures, over 7 figures, multiples of 7 figures, I think there's a much, much better way to generate significantly more cash flow and have optionality, not tie up something forever. And so we believe that, you can't tag us. And that's the beauty of, I'm hard to debate against. And I really like that because I have no preconceived notions of any investment strategy. None, zero, nada. I know there's strategies that are good. I know there's strategies that I don't think are good. And our job as advisors is to really let you in 25 to 27 years worth of experience and figure out how we can craft a portfolio for you that we can look at our clients and we can say, yes, this bucket of money, if the markets go down 10, 15, 20, 30%, which many are calling for, I don't know if it's going to happen. You don't know if it's going to happen. They don't know if it's going to happen. Historically, however, says that we are due for a rather meaningful correction or a prolonged period of low growth. But if that does happen, we can look at our clients before it happens and say, this is what this bucket of money is going to do in that type of a market. So this is going to make, like, the bank notes, right? Citi, Bank of America, Morgan Stanley, UBS, JP, et cetera, et cetera. We talk about them at length on the radio show. This note priced at 12%, this note priced at 11%. You're going to get that paid annually, broken down into monthly payments, as long as the indexes don't go down 30%. And if they're down 30%, then you miss a monthly coupon payment, interest payment, call it what you want. If it's not down 30%, then you get paid. There are risks, of course. I mean, you have the credit of the bank. That is a big one. That's why we're only using the largest and strongest, most, financial institutions. I mean, if you think that, the JP Morgans or Citigroups or Bank of Americas are going to go under, we have issues, and I don't know what the investment vehicle would be. So, but that's our job. That's the advisor's job. The advisor's job is to look at a portfolio, and in a 30-second elevator pitch, if somebody asks me what I do, I try to reduce taxable income for individual investors. Try to reduce taxable income for individual investors, and I try to make sure that if the markets go down, that we have strategies that can protect and still deliver positive returns. That's what I do. That's what my firm does. That's what my team does. The up markets, they take care of themselves. You're not going to make a change because, we can go and beat the S&P by, 2%. Now, our growth strategy, historical performance, back-tested, not back-tested, real historical performance, yes, it has beaten the market, but you don't invest because of past performance, because it's not indicative of future results. So 630-492-1912, 630-492-1912. If you have any conversation, if you want to have a conversation with us on anything financial related, just give us a call. More after the break.
Are you close to or already in retirement, and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 630-492-1912, and find out more at KuhnCP.com. That's KUHNCP.com. You're listening to Destination Retirement with Robert Kuhn. Still to come on today's show.
A lot of individual investors, what they will say once they, hear our story on the protected growth, the opportunistic growth, and then the tax reduction strategy, on the banknotes, it really becomes, why doesn't everybody do this?
That and more still to come on Destination Retirement with Robert Kuhn.
Planning for retirement is kind of like planning for a trip of a lifetime. First, you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. Thank you for listening this great weekend, or if you're catching it on the podcast. We do a podcast every episode. I love it. I absolutely love it. I love to have the ability to educate investors. I love to have the ability to talk with investors about strategies that can still deliver positive returns in negative markets. I love to talk about strategies that can reduce taxable income. I love to talk about these strategies. That's why I love to do the radio. And we're trying to look at different markets. We're trying to increase the outreach of the radio show, because we've just done I guess I don't pat myself on the back very often, but I think we've done a good job, because I know how fast we're growing. I know the interest level that just here in the Chicago market and the other markets that we're in. I see just how much interest they have and investors have in learning. And that's who we work well with. We work well with people who want to learn. We work well with people who want to incorporate strategies that we ourselves, that advisors will utilize for their own portfolios, or at least have, it was what they look at. And again, it just bothers me when I see these cookie cutter portfolios out there that I know. Well, I guess I don't know for a fact, but I have a I believe that the individual investment advisor is not just buying a 60-40, 70-30 portfolio and then letting it ride for themselves. Most don't. So 630-492-1912, 630-492-1912. I've been dealing with a cold, like many people, obviously. Goodness, my kids, it seems like they've missed so much school here recently. But I am trying to get back this radio voice. So I do apologize if I am coughing a little bit or I sound a little hoarse during the radio show, but I am feeling better. So that is a very, very good thing. So we're excited about 2026. We're excited about, we look back at 2025, and I don't know what the number will be, but in new issuance of the banknote strategies, and we use banknotes as just kind of a catch-all because every bank has a different name for it, albeit they act, the ones we use act the exact same. But I think we're in this $50, $60, $70 million range of new issuance of banknotes is where we'll finish the year. And I can understand why, because a lot of individual investors, what they will say once they hear our story on the protected growth, the opportunistic growth, and then the tax reduction strategy on the banknotes, it really becomes, why doesn't everybody do this? And I stop and think about that a lot, because there is no perfect investment, right? There is absolutely no perfect investment. If you have, some may say, well, we can go and buy CDs and we can go and buy a government-backed bond. Well, how are we classifying or how are we determining what, a perfect investment is? No loss. Well, okay, good. Well, that is going to provide that. But what about, not keeping up with inflation? I mean, if inflation is going to run hot, which is our personal belief, 3, 4, 5, 6%, what is your real rate of return? Because you just take your return minus inflation and then that's, your real rate of return. That is, you're outpacing, inflation. And, so when we look at, what is a perfect investment, I don't think there is a perfect investment. But when we look at protected growth, that 5-year index annuity strategy, again, it's only 5 years and it's tied to the S&P. That is the big difference. So many of these annuities out there today, and we can go down rabbit holes that I don't want to get, down today, but these indexes that have never been around, that these insurance companies are allowing these insurance agents to run out there and show this hypothetical back-tested data. And the insurance agent who holds themselves out as a financial advisor isn't articulating to the investor that this is hypothetical and back-tested in nature. I mean, that's an issue. And so when we look at protected growth, again, 5 years, that's it. Sure, 5 years, that's it. And tied to the S&P. Everyone knows the S&P. And the current participation rate is, or cap, we use a cap, is 10.75 on the strategy that we use. Now that can change, but currently it's 10.75. And so when we look at protected growth, we can look at a client, we can say, listen, for some of your money, if we know that our worst year is 0 and we get the first, 10 3/4 of the price movement of the S&P on an annual basis, at least that's what it is currently, 10 3/4, and that's locked in for the year and then it can change. That's a really good strategy. And then when we look at the banknote strategy, again, the banknotes, when we talk about them over and over and over again, and we're still pricing it at 11 to 12% with 30% downside before you don't get paid your monthly coupon. Now, again, read the prospectus. I encourage you to read the prospectus. Look at the one-pagers. Do your research, right? And then let's have conversations. Those are the things that we want to talk an awful lot about. So 630-492-1912, 630-492-1912. I want to spend the rest of the show on the energy strategy. Why? Well, because if the markets go down, I think it's great to have a strategy that still targets cash flow in, the 10 to 20% range. Also, because of the tax benefits, I can't provide tax advice. Please take this for informational purposes only. It's always a best practice to reach out to your tax professional. The tax benefits in energy and oil and gas investing are very black and white, and they're very, very favorable. And our target is, for every $100,000 you invest, is for you to receive a tax benefit of at least $80,000. that can reduce your taxable income by $80,000 per $100,000 invested. That's active income. That's passive income. So people who have embedded capital gains, people who have concentrated stock positions, if you sold a business, if you sold a building, if you have, you want to do Roth conversions and still mitigate, that additional taxable income. These are the strategies in the energy strategy that we can address. And if you look at oil, I love it. When we're still acquiring assets, all we're doing is so simplistic, is taking ownership deals in the majors projects, 1%, 3%, 5%, 0.5%, whatever. And when I say majors, it's the Exxon, Chevrons, Conocos of the world, the big guys, right? And you, and then when you look at what the fund is, at $50 million, which was this fund, and we'll probably up the next fund to $250 million. But, at $50 million, we have interest in, a targeted 150 wells, targeted 50 permits, targeted 1,000 acres. That becomes a strategy that if the markets do go down, and when you're acquiring assets at low oil prices, and there are very few people that think low oil prices are going to stay this low forever. Many actually think it's going to be the opposite, where they're going to, dramatically jump in the next 2 to 3 to 4 years. That can become a really, really strong investment. So not only does it have the tax benefits, but it also has the return characteristics, the cash flow, while we own the asset, and then, an exit, valuation when we sell it. And if we're in a period of market weakness or low returns, like many, many people think that based on where the valuations of the markets are now, that is going to be the case, well, that is a phenomenal strategy. How many investment advisors can you talk to that have access to that strategy? Well, nobody has access to that strategy because it's ours, unless we open it up to other advisors, which we have, and we continue to do selectively if it's a good fit and we think that they're going to utilize that strategy for their clients appropriately. But you have until the end of the year. So it's whatever, date is, you've got 15 days, 14 days, 13 days left, to take advantage and to affect your 2025 taxable income. So 630-492-1912. 630-492-1912. So I know we went through a lot this week. That's typically what we do on the radio show. We talk a lot about a lot of things. And again, my job is just to make sure that you are educated on ways to make sure that you have strategies in place that can still deliver positive returns or a level of protection if the markets go down. We don't spend a ton of time talking about our growth strategies, but again, our growth strategies, look at our growth strategy. It's a money manager out of Chicago. Again, past performance, right? Past performance is not indicative of future results. But if you look at what that strategy has done since 1995, the strategy that we use, which is the all cap and the focused growth, that strategy since 1995, and you can take a look at it, and it's, this is, they report into all the major reporting agencies. It's outperformed the S&P 500 by almost 1.6, 1.7% a year, net of a 1% management fee. Doesn't sound like a lot, right? Does not sound like a lot. But again, don't interrupt compounding unnecessarily. That strategy is up 1,300, 1,400% over what the S&P 500 has done. Again, past performance. I have to give you that disclaimer, right? I'm not saying that they're going to do that for the next 25 years. One of the reasons I think it's highly likely is because they are a quantitative asset manager. So it's more computer based than gut feel, but we just want to craft portfolios that at the end of the day can outperform the market, whether the markets are good or bad. So if we can help you, give us a call, 630-492-1912, 630-492-1912. Have a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.